Start of global banking crisis? David Lynn interviews Sam Burns. Sam Burns is the chief strategist at Mill Street and discusses the economy's prospects. He believes the economy is still holding up well, but the risks are that the Fed will raise interest rates too much, leading to a slower recovery than would be otherwise. He also believes the economy still has momentum coming into the year. The White House believes that low unemployment is not a problem, but the Fed is looking at it as a concern if it becomes too tight. The unemployment rate has ticked up, but the average hourly earnings growth has slowed. There are signs that the labor market is starting to become a little less tight, but the question is how far does inflation have to go before the Fed considers the pressure from the labor market. The last Great Recession in 2008 saw unemployment take up to nearly 10%. The economy is more resilient to the Fed right now due to what happened during COVID and the fiscal support. This suggests that the next recession is more likely to be caused by some combination of the Fed keeping rates too high for too long and fiscal policy becoming too tight. The last recession was unusual in that it required both a catastrophic breakdown in the financial system and a weak fiscal response. If we avoid those issues, we may end up having less of an unemployment rate and fewer people around to fill jobs. The labor side of the economy is likely to hold up better than other parts of the economy, and the contagion issue is likely to be limited to banks and firms directly exposed to venture capital. The Fed could be over-tightening and overdoing their monetary tightening program. It is difficult to know how tight is too tight in real time. The Fed has also made comments that they are more willing to make a mistake of over-tightening than of under-tightening at this point, and that this has to do with their public opinion and credibility. The Federal Reserve has a lot of work to do, and the lagging data is not indicative of what inflation is going to be over the next 6 to 12 months. Looking forward, the Fed is already tight, and if you look at their economic projection data, it shows that the long-run expectations for where they think interest rates will settle down are well above where they think normal rates should be given. This suggests that we are well on the way to normalizing interest rates. The Fed is obligated to claim victory until they see the data slow down, and as the trailing 12-month figures start to move forward, the numbers will look better and the Fed will have less pressure to keep the extreme view. However, they have to keep the option open to avoid the perception that they are giving up the inflation fight. Rates have been higher before, but the equity markets have continued to climb despite higher rates. Investors still expect inflation to come back down in the next couple years, which could lead to an inverted yield curve. Investors are adapting to higher rates and corporate earnings are holding up okay. Sam Burns is underweight bonds relative to a benchmark and overweight equities. He thinks equities have more potential upside than bonds, but they don't think stocks will continue to outperform bonds. He also thinks stocks can benefit from inflation in the form of earnings and bonds don't, but there are still some headwinds. The cyclical side of the economy has caused a lot of layoffs in the tech sector, but this does not necessarily mean that companies are focusing more on costs. Overall, the job market is still good in those sectors that may have been laid off or finding new jobs.